the show. And before we talk about inflation and its impact on your investments, I have a viewer that's joining in from Dubai and wants to ask you his question. I have Tony from Dubai on the phone line. Tony, hi, good evening. How are you doing?
I'm doing good, Kavita. How about you?
I'm doing good. Thank you. Thank you so much for sending us your query also. Is there anything else that you want to add to the question that you've already sent?
Yeah, maybe I'm 33 years old. I don't know if I put that in the message, but yeah,
33.
I'm looking for a horizon of maybe 25 to 27 years.
Sure,
yeah.
Sure.
And an investment horizon of 25 to 27 years. Yeah.
Okay, and you want to increase your SIP with 10,000 more, and you want to add a mid-cap fund. Any particular reason why you want to have a mid-cap fund? And the existing funds that you have in your portfolio, Tony, is this your research-based fund, or you're already consulting a financial planner?
No, it's all by myself. So yeah, the 4 funds that I have chosen at the moment, it is all by myself. Yes.
All right, so let me just confirm. It's Parag Parekh Flexi Cap, UTI Nifty Next 50, Quant Infra, PGIM Small Cap, and now you want to add a mid cap fund. Any reason why you added a Quant Infra fund?
Yeah, I was going through the selection of the stocks under this fund, and it looked a bit attractive to me. That made me to select this one. I don't know if it was the right decision, and that's what I'm trying to figure out from the experts. Yeah.
Tony, any corpus that you want to accumulate in this time period, 15 to 20 or 30 years that you've mentioned?
Yeah, between 25 to 30 years. I'm looking at maybe 20 to 25 CR.
20 to 25 CR. All right, so let's ask.
Currently, I'm investing 80,000 put together. I hope you have the details, right? Yeah.
Yeah. All right, so let's connect Feroze now. Feroze, how are the funds looking?
Yes, Kavita, there are several things. Of course, the funds need some change. Firstly, Tony, coming to the mother question, which is, will you be able to accumulate the 20-25 crores which you intend to? The answer is a yes. Because you're 33 years old and you might have some debt in instruments anyway, in the form of bonds and stuff. So from this SIP standpoint, if this 90,000 rupees were to be invested for 30 consistent years, month on month, if the rate of return you expect is 14%, you will be able to grow this money to almost about 50 odd crores. So that's the power of compounding. So that's point one. Of course, 50 crores might sound very large today, but 30 years from now, its value would be equivalent to 8-10 crores of today. But it's still going to be a handsome amount. So that's point one. Point two, you have 4 schemes. You need more schemes. That's my first initial reaction, because you're not investing 5,000 rupees. You have enough corpus to actually have 8-10 schemes in your portfolio. That's point two. Point three, coming back to Kavita's question, are the schemes good? I think I would recommend you to exit 2 of them. If you don't wish to exit because your installments would have been going on a recurring basis, you could probably stop the further installments and then remove these 2 funds, accumulated units after the exit load periods are over, UTI Nifty Next 50 and Quant Infra. Having said which, then since you're a Dubai resident, there is also a dual taxation treaty between India and the UAE, which makes mutual funds tax-free for a Dubai resident. So if you take a TRC, which is nothing but the tax residency certificate, you'll have to go to the Emirates IDs and you have to go to those Emirates office and take a TRC for yourself. It has some 1 lakh rupee cost per a certain period. Then your mutual funds in India become tax-free, and even the TDS deduction becomes exempt to you. So that's one thing which I want you to keep in mind, because that's a huge advantage of living in Dubai. Coming back to the schemes which I can read out to you, which is a laundry list of them, you can make note of those, and you can have probably 10,000 each rather than having 25,000 in any of those. HDFC Flexi Cap, ICICI Focused Equity, SBI Contra, SBI Large and Mid Cap, Franklin India Blue Chip, HDFC Small Cap, ICICI True Dividend Yield Fund, Kotak Emerging Equities, and Kotak Multi Cap Fund. So these are the schemes which you can surely look at adding into your portfolio and subtracting the 2 which I just mentioned.
All right, Tony, is there anything else you want to ask?
Thanks, Feroze. I just wanted to ask, so he recommended me to do a 10K investment on all these funds rather than going with 25K or a bigger amount. Did I understand that correctly?
Feroze?
Kavita, I couldn't hear Tony very clearly. If you can tell me what was
Can you
his
repeat
question.
the name of the funds once again, Feroze?
So you want the repetition of the names of the fund?
Yeah.
Of course, HDFC FlexiCap, ICICI Focused Equity, SBI Contra, SBI Large and Mid Cap, Franklin India Blue Chip, HDFC Small Cap, ICICI Blue Dividend Yield Fund, Kotak Emerging Equities, and Kotak Multi Cap Fund. These are in total 9 schemes, and you have 2 already, even if you exited the other 2. I personally think even a 10-11 scheme portfolio for your kind of SIP amounts will do justice because funds are cyclical. So it's important to diversify them optimally.
Tony, these are all equity-based schemes, and Feroze, if he wants to increase his SIP, step up his SIP by 10,000, what fund should he be selecting?
I think these his 80,000 plus 10,000, that's 90,000, could be divided into the 9 schemes which I read out. So 10,000 each.
Tony, thank you so much for sending us your question today. And if at all you've missed anything, the show goes on YouTube, channel YouTube. You can maybe look at it once again over there. All right, we move on. A penny saved is a penny earned, but owing to inflation in the economy, the value of the penny saved could be much lesser than when it was earned and saved. Therefore, it becomes essential to understand the effects of inflation on savings and investments. Even more important is to invest in savings and investment plans that can help you keep the inflationary effect on your income in check. So, Feroze, first question, having inflation in mind is one of the key rules in financial planning while you're aligning your investments with your goal or even when you're deciding a corpus that you want. But looking at the uncertainty around, do you think we need to reassess or revamp this particular goal, keeping inflation factor in mind? How can inflation actually eat up in your investments?
Yes, Kavita. See, uncertainty is going to be a part of our lives. Inflation is also going to be a part of our life. So inflation is nothing but price rise, mehengai, all those are synonyms to the same thing. And how important is it? This is so important that you can't even begin planning without factoring this in. Let me give you an example. When you are saving money, it is nothing but that it's nothing but money stored to consume later. Let's assume I keep 5,000 rupees to buy a shirt. Let's assume this shirt today costs 5,000 rupees, but I don't want to buy all my shirts today. Let me assume that I store this money and invest it well. It transforms itself to 6,000 rupees in a year's time. Now I have 5,000 grown to 6,000. Now if I take the 6,000 after a year and go to the shopkeeper and ask for the shirt, if the shirt is priced at 7,000 rupees, I won't get the shirt. So I was better off buying the shirt rather than storing my money. So it's very important that the money grows at a pace greater than the value or the price of the shirt. So that's why inflation is very important. Otherwise, optically, you will be growing your money. But in terms of its power to purchase the commodity while you've stored it, may not be the right case. So important thing is to make sure that your money grows greater than inflation.
All right. I think a lot of other aspects are there to this particular discussion and this particular topic, but then we will touch upon it once again. We have to really go back to our viewer queries, and till the time I get the callers on phone line, let's just take SP Shivakumar's question, Feroze. And he says that he's invested in IDFC Tax Saver Fund, and total SIP is 56,000, and now he says that he has stopped it after the lock-in period is over, and he is not sure if he should be redeeming this amount. He's asking whether he should be there in this fund or continue. He continues SIP. I think we have Mr. Shivakumar on the phone line with us. Hello, good evening, sir. How are you doing?
I'm fine, madam.
Thank you so much for sending us your query. Sir, any reason you want this money? This particular tax?
No, I don't need that money, but I had a SIP in this fund. After some time, I stopped this fund, and I'm keeping it open for this fund.
Okay.
So what should I do? Whether to book the profit and keep the money and invest in some other fund, or I just wait for that. I know I don't require this money at right time.
But do you need the tax benefit?
I had a tax benefit. Media asset I'm having.
You already have that
tax
in
saver.
place.
Yes.
So
yes,
could
yes.
you tell me your existing portfolio, because that if at all we want to suggest you a fund, there should not be a repetition.
Okay, I'm having Tata Digital. SIP is going on, and then Canara Ropico Small Cap, and Axis Hybrid Fund I'm having, and Tapa Balance Advantage I'm having.
And you also said
All
Mira
are
Asset Tax Saver.
Yes. I'm also having Mira as a tax saver.
All right. Okay. So Feroze, Tata Digital, Canara Robeco Small Cap, Axis Hybrid, Tata Balance, and Mira Asset Tax Saver. What should be his strategy, Feroze?
See, I think Mr. Shivakumar should actually first look at it top down, his portfolio. He does not have several categories which are very critical. Now, for example, having a Tata Digital Fund, which is a sectorial fund, of course, its performance about a year back was very good. So there was huge influx of money in digital or technology-based funds. So those are sector funds. So Mr. Shivakumar, you will have to actually also remember exiting them. So it's very prudent to exit and not have thematic or sector funds in one's portfolio, because exit becomes so much more important. So that's message one. Message two is that you have Canara Robeco Small Cap, which is a great fund. Sri Datta is the CIO. That you can continue. Axis Hybrid. If you have reasonable amounts of money, you are better off separating debt and equity from rather than buying a hybrid fund. Of course, there's a little tax change in the budget. But hybrid funds become a little more attractive provided they have more than 35% in Indian equity. Having said which, I would not have an Axis hybrid for sure. You have two ELSS schemes. One is the Mirai and the other one, the Bandhan tax saver. If you've already finished the lock-in, I would certainly suggest you exit these, because having an open-ended scheme makes so much more sense, because there's no evidence that lock-in provides more return, because you've already finished the lock-in period and you also have taken care of your section ADC already with other instruments. Just redeem it and diversify into the schemes which are flashing on your screen, because they're very carefully chosen different categories. There are 8 very important categories which you should be a part of before you go on to have the 9th, 10th category like a sector fund. So the schemes are there on your screen. I'll read out to you: HDFC Flexi Cap, ICICI True Focused Equity, SBI Contra, Franklin India Blue Chip, HDFC Small Cap, Kotak Emerging Equities, and Kotak Multi Cap. These are schemes from different categories which can complement each other and support each other, and try and make sure that diversification is true to label.
All right. Shivakumar sir, anything else you want to know from Feroze?
No, madam. Thanks for your suggestion. I'll be certainly a liquid IDFC tax saver fund, and I'll move that money to some other fund he has suggested. But
Thank you
I
so
don't
much,
have
sir.
any flexi cap. I thought that it is better to invest in flexi cap also. Thank you.
Thank you.
Thank you, ma'am.
We move on, and Feroze, we have Rishab on phone line from Bhilai. Rishab, hi, good evening. How are you doing today?
I'm good. Hi, sir. Hi.
Thank you so much for sending us your query. You want to invest 6 lakhs for 10 years. Any specific goal that's aligned with this investment?
Actually, I have to divide this 6 lakhs into 1.5 into 4.
Okay.
So this needs to be invested as lump sum amount in the mutual fund.
Got it.
So for the long term, I just need in which mutual fund I should invest, and for the long term, so that it will give a better amount of return.
Yeah, so I just wanted to know what is that better amount in terms of corpus. How much do you want to accumulate?
Around more than 1 crore.
All right, so let's just take 1 CR. Feroze?
Kavita, see, Rishab's expectations are reasonably unfair. Because 6 lakhs grown even at 14% will compound to 22 lakhs in 10 years. So mutual fund can only give you a return of 13 to 15%. If Nifty delivered 10, 11%, these active funds have the potential to give you that 2% extra return per annum. So 13 to 14% is good quality return, because today, even if you bought an FD for yourself, you after tax will only get 6% or 5%. So if you're going to get 2.5, 3 times more than an FD return on a post-tax basis, because the taxation is reasonably liberal in equity and in equity mutual funds as well. So I think that's what you can expect. So 22 lakhs is what your 6 lakhs can grow to in a situation where Nifty grows by 10, 11. These funds give you 2, 3, and that's when you're compounding your money at 14%. To get to a crore, you need 25, 30% kind of compounded returns, which are not possible in a mutual fund for sure. You can buy stocks, but those stocks can also make your money half even after 5 years. But mutual funds, because of its diversified nature, do not stay below the purchase price for long periods of time. So that's point one. Point two, I think that you should divide your money not just into 4, assuming that you also have enough debt allocation in other instruments. And I assume that this 6 lakhs is only for equity purposes. Since you're investing lump sum, there are 2 pointed questions which come to my mind from your perspective, is whether should you invest lump sum today or you should stagger it in a 6-month period. I personally think since the market has gone through a 1.5 year of time correction, I wouldn't mind investing all 6 lakhs at once, maybe in a month's period, over 4, 5 installments in the same month, like June. That's point one. Point two, do you need 4 schemes or do you need 5, 10, 15 schemes? Maybe I would say 7, 8 schemes would be more prudent, especially because you're investing lump sum. So the schemes which we read out to the previous investors, I'll have to repeat that, and they're already flashing on your screen. Franklin India Blue Chip, HDFC Small Cap, ICICI Blue Dividend Yield, Kotak Emerging Equities, Invesco India Multicap, Kotak Multicap, Invesco India Small Cap, Kotak Multicap. These are some of the schemes, HDFC Flexi Cap, ICICI Focused, SBI Contra. So these are 9 schemes. You can divide your money in those 9. And be rest assured that 2, 3 of them may not be the best schemes, but the other 6, 7 will make up for the bad ones. And nobody can choose all schemes which are going to do well. But this is more prospective in nature rather than retrospective, the research.
Rishab, thank you so much for sending us your query, and I hope you've noted down the name of the funds. Just in case you missed anything, you can watch the show on the channel's YouTube and again get the detailed list of your recommendation. With that, thank you so much, Feroze, for being on the show and helping our viewers with their financial portfolio queries. And time to sign off, but I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your queries. Anything related to your mutual fund or your insurance